we have an investment policy statement with our investors, and it tells us how we're supposed to behave, and we're going to stick to it, and how you're supposed to behave and what you're supposed to do. But when we get put in hot situations, we might behave a little bit differently. That's the reason we have to rehearse in advance. What are we going to do if something happens, if we get put in that hot emotional state? If you haven't rehearsed what you're going to do in a hot state, and you're not totally committed to your prudent diversified portfolio, what's going to happen? And it's not just in investing, it could be in relationships too. What if you get put into a hot situation with your boyfriend or your girlfriend, and someone else comes along? You have to rehearse in advance what you're going to do if you get put in that situation. Same thing with investing. So I have rehearsed what I'm going to do. I'm going to show you what I did during the European financial crisis of 2011. I'm going to show you my actual 60-40 balanced allocation, my actual account. And a lot of you guys that were here with us in 2011, I can see many of you guys were here that long, went through the same thing that I went through. So this was August 8th, 2011, and that was just a few months before the bottom, which hit in November. So this was the headlines. Wall Street had its worst day since the 2008 financial crisis, as fearful investors reacted to the United States losing its coveted AAA credit rating. All three major U.S. stock indexes sank between 5 and 7%, pushing the Dow below 11,000 for the first time since last November. Kind of looking back at it, doesn't seem, right now it's around 24,000, 25,000. U.S. stocks have fallen 15% in 2 weeks during that time period. And these were the headlines. Investors were fearful. They were in a hot state. So here's my account during the European financial crisis, 60-40 balanced allocation. During 7 months, my international equity was down 28%. My U.S. equity was down 21%. My fixed income was up during that time period. So my total account wasn't down 28%, but my total account during that 7 months was down 16%. Still unpleasant to go through though, right? And I have no idea when the bottom's going to be. Nobody knows when the bottom's going to be. So the account went from $122,000 down to about $102,000 at that point in time. To give you perspective, it's about $168,000 today. And I haven't added any money to it. Okay? Discipline. But here's what I was going through. This was November 21st, 2011, what I was seeing in the news, what you guys were seeing in the news, 3 days before the exact bottom. Of course, we had no idea at the time that that would be the bottom, but this was 3 days before the bottom.
Less than a minute to go to the close in Europe, and Simon, can't emphasize enough that the pain over there has been just as acute as it is here today.
It is a monumental close that we're having in Europe. It's a horrendous start to the week for those that are long of Europe, and the losses in Europe are far greater in some pockets than we certainly have here, even though we're down 303 on the Dow, which is a loss of 2.5%. Some of these markets in Europe have lost almost twice that. It is a rough start to the week, no question, Carl.
Yeah, on a holiday shortened week here in the States, with our own concerns regarding retail and the consumer here. Obviously the Super Committee, which we spent a good part of the half hour talking about so far, but the concerns are going to be taking us back to Europe every day, as they have been for the last couple of months. Here's the bell for the European close.
The European markets are closing now.
So you can see that it is a sea of red.
A sea of red, and that was when the Dow was around 11,400. So here's my accounts by year. 2011, I was down 6%. That's because the beginning of the year was positive. The end of the year started to have a recovery already. So I wasn't down that entire 16% for the full year. But then look, plus 11, plus 18. So if I would have given up and panicked during that 7-month downturn, I would have missed that. Same thing with all you guys that went through that. You got the recovery. Identical portfolios can have different starting dates. It doesn't change the quality of the allocation. This is the different years in that particular account. Some people started here. It's tough to go through when you start right there, but then they got that and that. Other people started here. 2 years of slightly negative returns. John, you said I was going to be making some money. What's going on here? Then we have to have that patience, and anything can happen over short periods of time. But then look, +9, +12. Okay? It happens, and we don't know when it's going to happen, but we got to be patient because the upside percentages are usually higher than the downside percentages, and the upside periods are usually longer than the downside periods. Because remember, too, that was other people right off the bat started with that, too. Okay, then I have to caution them. No, it's not always like that, okay?